welcome to the webinar where we take a closer look at the tools behind our 3-point playbook portfolio. A portfolio that in 2025 hit an upside of 34.48%. Of course, we'll also take an in-depth look at the platform that is mystockscanner.com, and we will get to show you some of the features that we use on a daily basis. My name is Jesper Behrens. I get to ask the questions. We will give you the opportunity as well if you write us an email at fomo@mystockscanner.com, and we'll check out and see if we get an email or two if we have room for them. The guy next to me, he's the guy with all the answers, so I can freely say, bring us your questions. He will have to answer them. Liam Flavel, nicer for you to be here.
I'm one of the tools behind my stock scanner. That's what I always think when you say that.
Well, Liam is one of the persons behind both the portfolio and the website. Your partner, Hans-Henrik Nielsen, who has been dealing in stocks ever since 1987 when he got his stocks news from the newspaper and got his fingers dirty from reading it over and over again. But you will be here on your own tonight, and over the next 45, 50 minutes, you will be taking us through the playbook. You'll take us through the web page. But first of all, I gotta know, why did you build this web page with Hans-Henrik when there's loads of web pages out there?
It was effectively, we know each other quite a while now, probably about 12 years, something like that. And what we were looking at was using lots of different systems because we like various different individual bits of those systems to do our trading in. And then we were talking about it thinking, well, if there was only one system that had all of these features in, that would be brilliant, wouldn't it? And then after a drunken beer conversation, it was, well, we might as well build it then, mightn't we? And that was how my stock scanner was born.
And since then, there's been added quite a lot of features to it, and it's a website that's developing all along and all the time. There's always new features coming in, and we will get to see some of them, both those that are on its way, but mainly, of course, those that you use every day. And I warn you, in the beginning, it looks really complicated, but as soon as you get the hang of it, you normally say, Liam, it'll take you 20 seconds to see if a stock is worth investing in.
Definitely.
But Liam, when I look up at the other screens I have above the screen where you're featured on, I see a lot of red. I thought you were Irish, and that means green. Let's get to the elephant in the room, because it hasn't been sort of the most uplifting days the last couple of days. The markets have really turned red, and today was not very much different. Let's get to the elephant in the room. How is it to be an investor on a day like this?
It can be tough. It can be tough, and we've been through it quite a lot. Hans and I, you've been through the mill as well yourself, because you invest as well. When you're sitting there seeing your portfolio, I think our playbook portfolio is down 3% today, something like that, and it has been lower than that today as well. And you're looking at, I think between us, the three of us probably invest. This isn't to brag, it's just say we have skin in the game. We were down 60, 80, 100,000 euros at one stage today because we've got sort of a fair amount invested in this. What you need is a system. What you need is that, the last thing you need to do is panic in this sort of situation and just sell everything or sell stocks that are just down because everything else is down, and they will probably bounce over the next day, week, whatever. So making solid investment decisions when actually the blood's up and you're thinking, oh, how do I deal with this? That's where having a strategy and having a set of rules sitting behind you is so important.
And you're rightfully totally spot on here. The thing is, everybody is gung-ho to get into the market, and then they hardly know when to leave. We're going to talk about that here on the show as well, because you have a tendency to hang on to your stocks like you were married to them. You are not. No. Be sure how to leave your stock and take that decision before you get into them. And we're going to break down the numbers. We're going to run stocks through the 3-point playbook, and we're going to show something from our portfolio. We will be talking Pandora, Royal Unibrew, Rheinmetall, NOVO, of course. And we're going to have a mining stock as well that we're going to take a closer look at. And of course, we're going to have the biggest one of them all, and we'll get to that in just a second. But Liam, take us into the platform, because once you log in or once you sign up and you get access to the platform, show us what people are meeting.
Okay. Just one thing I'd say just before we go into the platform. I think we've got what 5, 6, 7 stocks that we're going to show today. At least 4 of them show, we reckon, about 50% potential upside going forward. So that's just to whet people's appetite on where we're going with this. And probably a little bit more now, because I calculated that about 6 hours ago. So with the market being down about 5% or something, then that could be a little bit more in the tank for us to go through. Let's go to the platform. And so this is my stock scanner. This is what you get when you log into the system and come up. There's not always a picture of us in the corner. That's just sort of advertising your website on there. The homepage is really designed to give you an overview of our articles and the text we send out to people all the time. So when you look at when you come into the homepage, it will have stuff on there that we've written. So if you look at say this particular article, it's something that I wrote earlier on this morning, about 6 hours ago, and it was looking at Nvidia investing in a couple of technology stocks, and I was looking at the pros and cons of what those companies do, why Nvidia invested in them, and actually whether we think they're a good investment opportunity now or not. One is, one isn't. If you want to go in and read that, but so we've got an awful lot of articles, webinars, old shows, and things like that you can go into and just read it to your heart's content. There's a lot of good stuff in there. As a member, there's some member-only content that, when you come in on trial, you actually get access to the stuff that gets sent out to the members. So here is a market scan that Hans Henrik will go through and look at today's new or yesterday's news and what the investment angle is on it, whether it should affect you, whether you worry about it. It's quite nerdy is probably not the right word. It's quite what we call macroeconomic focus, which is looking at the bigger picture. So things like what happens when the Strait of Hormuz closes. It's not just about oil. Things like fertilizer, aluminium also gets affected as well. So it's those sort of things that we bring up, so that we bring these things to your attention, so that as investors, you know what's going on, and you can look at things like, okay, I understand why silver fell. So that's the sort of thing that we do within the forum.
And
Then,
when you see the layout of the page, there is a rhyme and reason to everything. You sort of have on the left-hand side of your screen, you sort of have tabs going down, and then you also vertically have things that you can click on and do and search and stuff like that.
Yeah, you do. So the main exploring area is around here. Then you've got list to watch lists, which are groups of stocks that either you create yourself. So I've got a quality watch list that has 200, 300 stocks on, something like that. They're the ones that I'm particularly interested in, and I can delete those and add those. We've got screeners where we can go in and say, okay, we want screen stocks, all stocks with a high return on assets, which is just a particular metric that some people use to look at quality, and it's got to be greater than 15% in this instance. So you can have some complex screeners in there. Then you've got the portfolios, and this is what sort of we're going to sort of address just first for the first 5 minutes or so, because this is, as of last night, we were 4% up or so. Our portfolio on my couple of my, I've run about 5 portfolios with sort of for various different reasons. They're between 3 and 3.5% down today. So we're going to come in at about break even. And what effectively is happening that we can see is that the market is sort of going into what we call a risk off stance at the moment. And this will affect everyone at the moment. I had TradingView up just now, just showing the there's not an awful lot of green on the board here. You've got Spain down 5%. You've got the S&P 500 down 1.25%, France, and so on and so forth. And the only things that are really up at the moment are natural gas and oil going up there. So that's just show the breadth of the issues. The way this is affecting us is we tend to be invested in things called momentum stocks. So they're stocks that have gone up a lot. And you can see a momentum stock here. Sorry to flipping around. You can see that Samsung Electronics is a momentum stock. It's just been going up and up and up for the foreseeable future. And what you often find with momentum stocks is when the market decides it doesn't like playing anymore, as it does today, a lot of the momentum stock, a lot of the investors will look at that and think, I've made so much money out of Samsung, I might as well exit now. And then everyone does it at the same time. So there's an element of that in what's happened today in the market. The other thing that we're looking at is the potential for a global recession. Once oil gets above $100, that tends to be bring in quite a lot of recessionary forces. So that could push a lot of economies into into dropping, not having the money to be able to fulfil their social obligations, etc., and causing these things. And the last thing is, we think also this is inflationary. So with oil going up, that will push inflation up, and that will mean the Federal Reserve and central banks around the world won't drop interest rates, which tends to be, people tend to think that's a less business focused and less investment focused area.
And this is very macro
Yeah,
intro to. I know that somebody thinks this is very complex, but I promise you, I was a beginner as well, and it takes a little bit of time, but not as long time as you really think. In the portfolio, when you
yep,
click on that and you get to our portfolio, what you're looking at right now is the 3-point playbook portfolio.
it is.
What is it that you see on the screen?
What we see on the screen is initially a performance chart, and that basically, the blue bar and the area is our performance, and you can see here we're up 40.42 or 39.51 at the end, so 40% since we started in January last year. The grey bar here is the benchmark, which we've chosen as the S&P 500, but it's in euros because we're Europeans. Even I'm sitting in the UK, we still technically are in Europe. And so we're looking at it from a euro perspective. So because the currency markets also have an impact on what we do here, we can also see our drawdowns, and this is a really important part. This is actually more important sometimes than the actual performance that we've got, because what this shows is a level of pain that you might get by following this strategy. So you can see here that generally the drawdowns haven't been too bad, maybe 2%. So this is the drop from the very top, the highest point your portfolio has got to, down to the lowest point at that time. You can see here back in April when Trump's tariffs came in, the market dropped. I think the market dropped about, I can't remember, 20%, something like that on the S&P 500. For us, we only dropped about 7. So we were, and there are various reasons for that, and we'll go into that as we go forward this evening. But that really shows you, okay, if you can't handle, say, a 7% drawdown, then you've got to manage your risks in a certain way so that you don't hit that point. If you think you can handle 20%, that's a very different set of stocks that you might be able to get into. So that's there. And then we've got the percentage invested, which, as you can see over the last day, is tailed down, and it's tailed down again today because we're down to, must be, 45, 46% invested, and we'll probably stay like that for a little while now. Then you've got some monthly returns. So you can see, apart from March, and we're not over yet, we're only just started, we've had positive returns every single month for the last 14, 15 months. The S&P 500 has been much more variable than that. So you can see that, and then you can see the quarterly returns, and then we've just got a mix of the sector allocations in here. So we're pretty broadly mixed across most of the sectors over here.
And again, this is also, and this is where we get into the portfolio and the strategy for the portfolio. One thing is that we have various sectors that we're in, various industries we're in. But another important thing, and we can stress that on a day like this, Liam, is that we very rarely invest more than 2.5%, 3%, 3.2% of our entire capacity, I was almost
Yeah,
saying, but
yeah.
of our money.
Assets under management, or whatever you want to call it.
Exactly.
And that's the important point. That's one of the first things that we do to reduce down our risk. Is we tend to be in a maximum of 40 stocks at any one time. If one of your stocks, say, I mean, we've got Micron, which has done really, really well for us in the last 4 months or so that we've had it. It was down 10% today. If it's only 2.5%, 3% of your portfolio, and it goes down 10%, it only affects me personally by 0.3%. I can handle that. That's not an issue for me. So that's an important part about how we manage our risks and how we manage that downside. And you can see here, the result of that is actually our average profit and loss on all of our positions, we've had 134 positions in the last 14 months, is almost 9%. But our winners are an average of 22% winners, and our losers are only 6%. So we get out of stocks quite early, and we let the runners and the winners just run.
And again, don't worry, we'll get to some of the
We will.
rules that we have for this, because there are very specific rules in regards to how to get in, as we're going to talk about, but also how to get out. And I know a lot of people really are super interested in that. When do we take decision? Why do we wait sometimes? And why don't we wait at other times?
Yeah.
But we're talking about the platform here. You were coming towards and say we're looking at the portfolios. There's a couple of more things. Calculator give itself. The algos is algorithms that you can make yourself, or you
Yes.
can look at others and stuff like that. If you're
The algorithms, just very quickly, are automated processes that we're testing a few at the moment, but they use our stock scores and various parts of the system to automatically rebalance every month. So you can see here that our portfolios are up on average over the last couple of years now, 40% or so total return, 45%. So they're doing pretty well. It's an interesting time. Sometimes they do well, and the 3-point playbook, because it's a stock picking area, will probably maybe do less well. And so mixing and matching these things can be a good thing. And then finally, there's a learn section, which has loads of information on things like how to use the 3-point playbook, swing trading, etc., etc. So that's the platform in a very slow flyby, actually, because we've already done 16 minutes in.
And don't worry, if you think it's confusing, you can't break anything. So if you sign up for a membership or even just a test, don't worry, play around with it. You can't break anything. So just go to town, click on everything, and you will learn by doing, that's for sure. What people come here for is, of course, also to do research on their stocks.
Yep.
And why don't we get to it? Because that's the horizontal bar. And why don't we start with the biggest one of them all, in that sense that this is a smiling guy, and he's been smiling for a couple of years now, even though the last couple of weeks have been less smiley, surprisingly, because they're the biggest company in the world, came out with fantastic numbers, and the market said, we don't like it.
Yeah, they just shrugged, didn't they, and said,
Exactly.
something
Well,
else, please.
let's bring it up. Nvidia, the
Okay,
world's
so
biggest company.
yeah, we have about 80,000, 70,000 stocks on the book, so you can search for them very simply by putting the name of it in there. It comes up on top because there aren't many other Nvidias out there. There are sort of various ones on different exchanges, but the big one is out in America. And what the system will do is we'll just load and take us into the playbook dashboard. That basically just gives you a very quick overview of the key points of the company as we show people how to look at them. So the 3-point playbook, let's see what that is. It asks 3 questions before we buy a stock. The first one is it a quality stock? And we only are interested in buying and being in quality stocks because we think they're the ones that are going to go up more in value because they're the most valuable, because they're the highest quality. We also think that when the market does go into a downturn, they should be more protected than the others. Today's an interesting point on that one because some of ours has gone down more, but we can go through that as we go through the 2 or 3 different examples here. But that's the key area for the quality. So the first point is really highlighted on the dashboard once you get past the description, just by 14 to 16 different elements on here, and they're basically saying, giving us different metrics from the system, say, is this a quality stock or not? As Jesper said earlier on, I can tell within 20 seconds whether it's a stock that I want to do some more research on, just by looking at 3 very, very basic numbers. 99 out of 100 on the quality score. So that is saying that Nvidia is one of the top companies. That's no surprise, but one of the top companies in the United States. Great. So anything over 60 gets me interested. Certainly over 80 gets me really interested. Then you've got something called earnings per share, or EPS. And this is showing the white is historic numbers. So in 2025 or 2024, Nvidia returned $1.2 for every share, in profit for every share that it has outstanding at the moment. Analysts in the gold bars think that that's going to go up to 8.23 and 1066 over the next couple of years. So this year, there is 8.23, and then the following year after that up to 10.66. So we want to see stocks where this is rising, and we also want to see stocks where generally these are all in positive as well. And then you've got the PEG ratio, and the PEG ratio is basically how much growth is still left in there. So if the stock has really run up and investors have bought into it, that PEG ratio is going to be quite high. So we want something lower than 2.5, which is where this green bar starts coming in. Anything in this dark green below about 0.8, 0.75 is absolutely fantastic. So those three numbers that I look at, and not even 20 seconds, 5 seconds a lot of the time, will tell me whether it's something that I want to go and research a little bit more on, and actually scroll down the page even more. And it tells me that Nvidia's got a good upside because of the PEG ratio. It tells me that it's been earning, it's just absolutely crazy. And then we can go through and look at everything else. And we've got things like revenues. So as well as profits per share, you've also got revenues there that are going up in the same way. You've got a health score, which is something called the Petrosky F score, which is something an accounting professor called Joseph Petrosky came up with. It's a score out of 9. That's less and less important, and we may actually take it away at some stage because with companies like Nvidia, it's not particularly useful. Number of analysts that actually have it as a buy rating. So at the moment, the rating is 4.5 out of 5. So analysts absolutely love the stock. They also have changed their expectations on earnings in the last 30 days and the last 7 days by about 6 to 7%. So that we always look for something where the analysts are thinking the stock is going to go up in its earnings potential, and if it's going down, then we tend to take note of that and think that's something we're steer clear of. Then we've got a few other bits and pieces. We've got some return information. These are basically, they're called return on capital employed, return on equity, return on invested capital. You don't have to remember what these are. What it shows you is how efficiently the company takes $1 of your investment and turns it into earnings profits. That's effectively the best way of looking at these. So something that starts low and then goes up high is exactly what we want to look at. If you look at someone like Warren Buffett, probably one of the most famous investors in the last 80 years, 60 years, he generally says he won't invest in a company with a return on equity less than 40%. So, and Nvidia is absolutely fantastic at 76 there. Then you've got free cash flow, which is going up. So it was okay, a bit variable, and then the AI industry kicked in and is generating lots and lots of cash. Free cash is a brilliant metric because it can't be manipulated too much. Earnings and sales can, but free cash is basically how much cash the company has available in its balance sheet at the end of the period, and it can't be, they can't screw around with those figures too much. We've also got a metric of price by free cash flow, which in this way we like to have it below 40, 35, 40, something like that. So a little bit high. And the current ratio and interest coverage are debt metrics that are in the green to say we're all right. You don't need to understand all of these, and we're bringing in some help text buttons in here in the next week or so that will make things a lot easier. But what you're looking for is green across the board. If everything is green or most things are green, then that means it's a quality stock, and you can move on to the next stage because you've got a big tick in the box saying that's a quality. Now that's the first question answered.
And again, this is the first step of 3 steps that we have in the 3-point playbook. And again, as Liam said, look for green. It's not just because he's Irish he's saying that. It's because that's the signal color that we have. It's much easier to remember that green is good, red, stop, and think about it. But Liam, this is, again, as we said, this is one of the best quality stocks in the world. But that doesn't mean that it's necessarily a good buy. We saw that in this week that basically even good numbers don't necessarily turn into profit.
Definitely not.
As an investor.
As an investor, yeah, no, totally, and that is because that's the reason for the second question in the 3-point playbook, and that says, okay, we get it's a quality stock, but is it cheap? because if it's not cheap, if it's expensive, then there's less room for upside. There's just less room for profit for us. The playbook dashboard actually has question 2 on here, but what we'll do, we'll move to the full valuation system here.
And let me just say, as a beginner myself, that is something that you do very often, that even though that it's right below, then you go to the other one. Why do you do that?
It's because it gives us a bit more information on where these numbers are. And we'll go through this very quickly in a second, but it gives me the ability to actually either edit them or drag them up and down. It also gives me some historics, because what we're doing is we're saying, okay, historically, investors have been willing to buy here and sell here. Therefore, we need to know where they are historically, what the PE levels have been, what the earnings per share levels have been over the past 10 years, 20 years, or whatever your outlook is. So there was, and this is where all the data is collected into one place.
And I
Now,
just want to say, from my own point of view, is that it is sufficient to stay over there as a beginner. You don't need to go over here and move around with the stuff.
no,
It's born with information for you that you can spend on. But Liam,
yeah,
take it away.
yeah, so you can actually just move these lines around as much as you want, but yeah, we'll go into the full valuation system. So what we're basically saying is what we're trying to match. So this black line is the where the price, the weekly price is for Nvidia over the last 10 years, and what we're showing in these bands here is the prices, the PE levels, or the multiples and points where investors have either started buying. So you can see here, I've matched the drop and the very lowest point in April with our red line here. And the red line we call the bear case. So this is if the worst, if the crap absolutely hits the fan with Nvidia, where's the worst we think it's going to get? And actually, April last year was the time when everyone thought there was going to be a massive global recession. They thought that everyone was going to run out of money. They thought the US was going to just blow up in various different ways. And Nvidia dropped down to this particular level. You can also see it drop down to around there, back there. But in the new paradigm, in this new world of AI, that's the best indicator that we've got. That's where investors have said Nvidia is so cheap, we have to start jumping in now. So that's what we call our bear case, which, as I say, is the worst case scenario that we think is going to happen. The flip side, the green zone, is our bull case, and that's the best case scenario. That's if Nvidia apps are absolutely perfect. They execute their business plan fantastically. They carry on being the masters of the universe as they are now in the AI world, and that this is the top level where investors have started bailing out in the past. You can see it a couple of times over here. You could argue that the stock could be dragged up a little bit more, and I could just drag it up there to say, actually, back in 2024, the stock commanded even higher multiples up there. So you could say that it's there. I'll just reset that very quickly and come back to things. So I'll just reset that, screwed up my chart. We'll put it back there. And then, so that's the bull case. And then the base case is the one that we think is actually going to happen. And this is where we think, okay, it's not a perfect world. We don't think it's going to crash and burn down to April levels. We don't think it's going to exceed sort of these sort of levels. So where do we realistically think it's going to be? And this is where you come back to Nvidia and think there is potentially a 68%, maybe a little bit lower if we lower it and give it a bit more, 63% upside in the worst case scenario. And that tells me this stock is cheap.
See, now you are almost there in that sense that we are at two of the three legs that the chair has in our 3-point
Yep.
playbook. But just to do your due diligence, and you have to do that even though that the system shows you something, then you take the next step as well.
You do. I would just point out, when I reset the scores, I actually added in the next year's analyst estimates in there as well. So this is where this comes in, is what we saw originally. But so that's okay. We're absolutely fine. We know it's a quality company. It might surprise people to know that actually we consider it cheap at this level. So we think it could potentially double in value. So when we got that tick in the box, we go on to our third question, which is now a good time to buy? And this is where the picture is less rosy for Nvidia, because what you can see here is a stock that's gone sideways since August the 1st of August last year. Not really made much in the way of gains, but it's not really dropped too much either. So it's been very, very so-so in this. What you can see on my screen here are a few lines. So down at the bottom, we've got something called the MTI. That's the momentum trend indicator. This is basically the same indicator, but just over different timescales. The top one is the daily timescale. The bottom one is on a weekly timescale. And what it shows us is the stock in a strong uptrend or not? So if it's green, it means great. It's in a strong uptrend. As you can see, it started down about here. It doesn't quite hit the bottom. It never will, but it does confirm that you're in the trend. When you've got the weekly series coming in as well, which is slightly slower, you know you're in what we often call double green, which means that you're in a really strong trend and it's really confirmed that it's going up. So that's a good sign. We've got some users in my stock scanner that just trade on double green MTI, and they're getting some really good results. They get slightly more volatility because they don't control their entries and their exits quite as much, but they're very happy to take that risk on. So you can see here with these indicators, it flipped over to red a few days after it started just going nowhere, and it's been interchangeable between red and green since then. And you can see down here we've got the earnings here. So the recent earnings were absolutely knockout. Then up here you've got some green and red blocks. These are automatically painted in, and they're one of our indicators. And what they do is they show us, so you can see it here, it is support and resistance channels, and they show where the stock has either on the red bars turned around in the past and gone back down, or on the green bars hit the bottom and gone back up. So they paint these in automatically, and they tell us likely points where the stock is going to turn. So you can see here the stock is actually in this green bar and it's come back up again. Lastly, what we look at is something called the moving averages. So you've got the black line, which is a 200-day moving average. It's literally the average number when you take the last 200-day closing prices of the stock, and you just paint that as a line. You've then got the key thing here is this green line as well, which is the 50-day. They're the two that we use day in, day out. And you can see, and you'll be able to see as we look at more stocks going through, we've got, they often track the green 50-day moving average all the way up. And that's what we use. So we look at this and say, is it in double green? No, it's not at the moment. So is it above its 50 and its 200-day moving averages? No, it's not. So we wouldn't go into it. Those are the rules.
Those are the rules, and we stick to the rules. It's basically just how you do it. You've got to create your rules before you buy your first stock, and then live by them. I promise you won't die by them. You'll live by them, and that's how it is. And we're going to show you an example of that. We're going to move on to the next stock, and we're going to take up speed now as we go along in the show here, and to get to more stocks, and we give you more examples. So it is really learning by doing, by repeating what we just did. NOVO. It doesn't get more Danish than that. We could have brought up Guinness and we couldn't have been more Irish, but let's go with the pharmaceuticals here. NOVO, the stock that most Danes have, without a doubt. And it is a quality company, but is it investable, Liam?
No, not at the moment. Quality company, absolutely fantastic. Quality score 98. Then you look at the earnings, you think, oh, they're going down. I don't want a company that earnings are going down. Why would I buy? There are loads of companies where the earnings are going up. So that's where I would stop and say, actually, I'm not particularly interested in this stock. Hasn't got a PEG ratio because in fact, I don't know why it hasn't got a PEG. Yeah, it's normally because it's got a loss, but it hasn't. So I think analysts are expecting a loss. That's it, because it's dropped in value there. So it hasn't got a PEG ratio. So that's another thing. Revenues are going down as well. That's what the analysts think is going to happen. Analysts also think in the last 90 days they've dropped the earnings per share estimates by 12%. Returns on capital, these these important things that say how efficient the company is at producing earnings, not particularly good either. It's been going down for the last few years. Free cash flow is pretty good. Current ratio is okay. Interest coverage is okay. So debt, I wouldn't, I'd stop there. I wouldn't have even got down to the bottom of this particular page. But it's a slightly different story if we look at the earnings. Is it cheap or is it expensive? You can see it's been up in the stratosphere. We all know that. We can move this around to say, okay, it could go up by 320%. No one in the universe really believes that. I would guess there might be maybe a few. The worst case scenario is, where's the bottom? We absolutely have no idea. It should, in theory, if you look back in the past, be somewhere around here. So it should actually, it's probably gone below the bottom and been oversold, and it could have a significant upside in there. But we don't try and catch a falling knife. So we would say, okay, question one, no, it's not. Yeah, it's okay, but it's not a quality stock as we would look at. Question two, is it cheap? Yes, definitely. Question three is where it really falls over, because it's been in red far more on the MTIs than it has been in green for the last year or so. And if you look at the 50-day, the green moving average here, if we were in it back in, I don't know, we came out around here because the stock meaningfully dropped below the 50-day moving average and things just weren't looking good for it. So this is where we actually came out. And since then, it's used that green 50-day line as a ceiling. It hasn't been able to batter its way through that, apart from a couple of occasions, and then it came back down again. And until it actually goes up there and then drops down, and then maybe goes up, comes back down, and then thrusts back up again, that's the time when we'd say, yeah, okay, it's looking like it's in a good trend now.
I want to use this because this is where we talk about the exit strategy. So go back
Yeah.
to the point where you guys got out of it, because the trip up was like Mount Everest. Basically, it was an immense peak, and everybody thought that it was going to continue up because Wegovy, Ozempic, what is coming from Novo, but your rules told you to get out. Explain
Yes.
it slowly.
And the rules are the opposite of rule three. Is basically from a technical perspective, has this broken down? Would we enter into the stock now if we're at this point on the 29th of July? And the answer is no, because we've got reds on the MTI, which means we're actually in a downtrend, not an uptrend. So the stock is more likely to go down. And we're also below our 50-day moving average. And what we tend to find is that when a stock has moved up so much, when it does drop below that 50-day, it suffers quite a lot, because actually investors lose a lot of what we call momentum. A lot of these stocks have been hyped up massively, and NOVO is a really good example where investors are piled in because it's going up and it's been going up for years. Why wouldn't it carry on going up? And then as soon as you get to this point where it's not going up anymore, all the investors think, oh, I better start running for the exits. And unfortunately for NOVO, they're still running for the exits down here. So you can see breaking that 50-day, and then even if you held on to it and you saw this happen where actually it hit the 50-day and then got rejected again, hit the 50-day, then got rejected again, then went below the 200, that would be your killer area to say, no, I really need to get out of it. But we were out of it a little bit earlier than that.
And the thing is, and we admit that we never ever get them at the bottom, and we never ever sell at the very peak. We are waiting for these signals, and that signals we decided upon before. We might let them test it, but we won't let it drop like 20% below 50-day or 20% under the 200-day moving average. Just not how we operate.
Yeah, we did actually, just very quickly, because I know we've only done 2 stocks so far. We did actually come in around, I think it was around here, because we were looking at the technicals, and the weekly slightly slower, but the daily turned green. It started meaningfully moving up, so we went in here and then came out because it dropped below the 50 with a 3 or 4% loss, something like that. So yeah, we just exit out quickly, minimize our losses.
And that's the thing. Just because we have been with the stock and we sold it, we could look at it again. We can get back in again. So the thing is, you might lose out on 2-3% if the stock is going up. But on the other hand, if you take a little dip here and then you go out again, you might avoid a 20% drop or something like that. So Novo, big Danish stock. We're going to stay with the Danish, and this was an argument between the two of us because you will want to bring up Guinness, of course, and you said this is not a proper beer and stuff like that, and I said no, Royal Unibrew, they make other things than beer. Liam, Royal Unibrew, a stock, and we can disclose that it's a stock that we're in. Why did we get into it, and what's keeping us in it?
Well, we got into it because it's a fantastic stock. You can see 5 seconds, 90 on the quality score, earnings are going up, PEG ratio, it was
You're going to share your
actually.
screen, or you're going to share your screen and drink less beer while you're doing this.
Yeah, there we are. Okay,
There we go.
right, let's go again. 5 seconds. It's quality score of 90, earnings going up. The PEG ratio was around 2.1, 2.2 when we bought it. We bought it about November time. So that got us interested immediately. And since then, the revenues are sort of flattish. So it means they're actually making more profits out of the same revenues. Health score is fantastic. It's a 9. The analyst EPS changes minus 0.02% is absolutely fine. The returns aren't great, but it's something that we'll ignore if the rest of it looks pretty good. And then we look at the free cash flow, which is in green, which is great. The price free cash flow is below 35. Fantastic. Just shows us there's a bit more profit ready to come out of it. And the interest coverage is great as well. The current ratio, sometimes with the current ratio is basically the assets divided by the liabilities of the company. So it's how much the company could actually get rid of to pay off its debts in the worst case scenario. Sometimes with big companies that have lots of factories and warehouses, that can be a bit of a not the right indicator to be using here. So we can ignore that as well. So number one, tick in the box for it. It's a really, really good quality company. We came in around beginning of November, something like that. We could see, we were down at 497. It's gone up to 609. So we're up about 22% or somewhere around there. We could see these numbers back then. There was a minimum of a 13% gain, in our opinion, on the stock. There was a maximum of about 45% gain in the perfect world, and probably around 18-20% on the base case, which is exactly where we are at the moment. So we've sort of topped out and we're starting to drop down. So it's not cheap anymore. We wouldn't buy it right now, but we made the right decision back then.
Can I ask really quickly on the picture before I need you to step back, just one picture, because the thing is that a lot of people looking at it, and if you're new, you kind of look at the green line and see, oh, that was a ceiling for it. Now it came down. Shouldn't you have sold right there when it started coming down?
No, because you often see these things go down and then shoot back up again. So back here you can see it drop back down and then shot back up. I mean, so we don't normally use the valuations. We use it to support our decisions, but we don't use it as the main driver. The main driver is really when we look at the price chart to say, has it broken the rules on that? And the question 3, that tends to be where we come out. But if it's expensive, then we'll definitely look at it and say, even if it's a borderline case, then we might just drop out anyway, because we think, that could be the peak. What you could argue is that you could actually put the price up to here. This sort of coincides with the peak there and the peak there and the peak there. So sometimes it's a bit of an art rather than a hard and fast skill that where you draw these lines, and you've just got to look at it and try and fit in as best you can. But we tend to factor in the more recent data compared to the older data, because companies change, their makeups, their executives change. So Royal Unibrew is a stock that looks like it's peaking at the moment, but there is a little bit more, and you often find stocks blowing past our peaks. So we don't sell because of that. What you can see here is that the stock is actually skirting with being sold, and because it's run up, and we've started going down again. And if it actually meaningfully breaks below this line here, then we'll certainly strongly consider it. What you often find is the stock will break down below the 50 and then dodge back up really quickly. It dodged down below, some of the lines, over the past. So we don't necessarily hard and fast sell immediately as it breaks the 50. We normally give it a bit of room. So if there's another support point like there is here, the support point here is only it's 4% down. So we look at it and say, do we want to risk another 4% where it might bounce on this particular point, like it has a couple of times over the last few months, or do we just sell when it's there? If there's not too much down to the 200-day, this black line, then we'll also consider selling as well, or keeping it for that time and then selling it, if it breaks through the 200.
And one of the things that is about the 3-point playbook and mystockscanner.com, if you have a membership, is of course that you are privy to know what we are doing. It's not the same as we're telling you what to do, but you're privy to know what we are doing in regards to when we buy stuff and when we sell stuff.
Yeah.
I know one of the stocks that, of course, everybody was talking about a year ago, And that was a situation where everybody was looking to the war in Ukraine. Now we have a war going on in the Middle East. The stock we're talking about here is the German stock Rheinmetall. We could have taken Saab, we could have taken Kongsberg, we could have taken a lot of stocks. But that timing that you guys had, you felt that you saw something in the macro part of things back a year ago. And then you went into it as soon as it sort of fulfilled your rules. And then you
Yes.
also went out of it. Explain the reasons behind that for Rheinmetall.
Okay. Just very quickly, people will be able to see now. Top three, 87 on the quality score, earnings per share, the continuing, we'll explain it at a later date. PEG ratio, 1, fantastic stock right now. So that's one of the reasons that we really liked the stock at the time. It was very, very high quality. There was a bit of coincidence in here. We actually did a series of webinars and a theme for February last year on defence stocks and RHM. We looked at the quality of the value chart back down here, and it pretty much looked like it does here, just without this black line of the future coming in. And we were looking at it saying that is a complete no-brainer. You know, with the build up from Europe of throwing just billions and billions of euros at rebuilding their technology base in the armed forces, then it seemed like an obvious winner for us. And we actually rode it up. I think it was 176% from up here. And then when we sold it around June, July, everyone was going, "Why are we selling? It's a monster of a stock." And the reason why we sold was we got to this point up here where it was skirting with the 50, bouncing off more and more, and then it started using the 50 as its ceiling rather than its support point, and it didn't really go. And since we sold it, it's gone nowhere.
And
However, I
yeah, I
just
was
had
going
one
to say,
thing.
however, because you were looking at it right now and said, we might kiss with this stock again.
I definitely think so. You look at this, from a quality point of view, it's a really high quality stock. It's in an area where, we are at war, sadly, at the moment. So that is going to be a tailwind for it rather than a headwind. We're looking at this thinking, what's the downside? And the downside just to the end of this year is 26% if the stock is going to sort of stay about where it is, and it's low for where it's been in the past. So we see potential almost as much as we had last time out of this particular stock. From a would we buy it now point of view, you can see here, we've got double red. So no, it's trading below the black 200 and the green 50. So no, we wouldn't buy it now, but it's not going to take a lot for that stock just to pop up and go bananas for us again. So we'd like to see it do that.
And
And
the
that's
interesting thing also, if you take a stock like Nvidia and you take this stock as well, the thing is that they have been moving sideways, which means that all the averages has come up to their price and made them cheap all of a sudden.
yes.
Let's look at a stock that a lot of people have an opinion about, and right now it's doing an interesting dance with silver, because it seems like every time that silver is going up, then Pandora is going down, and when silver is going down, then Pandora is going up. What's the yo-yo motion going on here?
The yo-yo motion is basically Pandora buy silver to actually make their jewelry. And all the time silver is cheap, then they can make cheap jewelry and they make more money and more profit and their margins better. If silver gets really expensive as it did this year, then they really, really suffer. So,
But let's
and you
do
can,
let's do Pandora in the 3 point
yeah,
playbook. I want to see if it's a quality stock.
everyone who's been listening to this will automatically think, "Oh no, I don't want to buy that." And the reason for that, very high quality stock. We've considered it for the portfolio a number of times, but the earnings are going down. In the analyst's opinion, they think it's going to shrink down about 10% this year and by another 20% the following year. And because of that, we can't calculate a PEG ratio. Revenues are going up, but they're saying that the increase in the silver price is here to stay for a while. Analysts have dumped 20% off their EPS estimates, so that's red. Apart from that, the company is really, really good. We really like it. If we look at evaluation, you can see it's very like Novo. It's traded up here, and it's now trading all the way down. And we can see that if from where it is now, because all these earnings are going down, we think in the best case scenario, yeah, there's a 72% upside. But actually, where we think it's going to be, where investors are sort of, on average, bought, in the past and been happy to invest at, we could break even at best. And the worst case scenario, if it stays down where it is now, then a 40% loss. So this is one that we wouldn't go near.
And again, these are the rules, and we stick with the rules. It's not. We can see this potential. We can see potential in a lot of different stocks. And Liam, I know that you don't have the exact number of how many stocks that we have in our system, but it's close to 80,000 or something
Yeah,
like that.
yeah.
So there's plenty of other stocks to buy if that's what you.
And this is what I talk about a lot is, okay, this stock, we're not interested in that. I have 300 others in my watch list that I can switch to that actually might be more deserving and might have a better upside. And some of them, the most interesting ones for me are the ones that are really, really boring that, just sit there and plod along and we make 30% out of them.
We have a question that came in on our email form at mystockscanner.com in regards to mines, and we had prepared a mine stock, and let's go to it because now we came for Pandora, and I know that we're almost breaking our rule about being longer than 50 minutes, but we're going to do it just because it was an email. A question about a stock that we might have to disclose that it's in our portfolio, FCX, Freeport McMoran. It's not a gold stock per se, but they also do gold, but they do everything basically.
They do everything, primarily copper, but there is gold and silver in there as well. The copper was the interesting thing because there's a huge demand for copper because the AI data center build out and all the new weapons being created and things like that. So from a playbook point of view, I mean, everyone who's watched this can probably read this themselves by now. 76 is brilliant. Numbers going up, absolutely fantastic. PEG ratio 0.47, brilliant. Everything pretty much apart from return on equity is going in the right direction. So as a question one, absolutely fantastic, and the analysts love it as well. They put EPS, they've expected the earnings per share to go up by 44% from where they had it 90 days ago. So absolutely fantastic stock, and that's what got our interest a couple of weeks ago when we bought into it. Even though the stock is in expensive territory, it's skirting along this green line, it's one of the nice things we always look for. It's chosen a line to go along, or we position the line where it's crawling along that. So that's a trend that hopefully will continue. And if it does continue, we could see the stock doubling up to 95% in the next couple of years.
And what you just did was also when you placed your marker straight at where it's at right now, you have a vertical line and you can look over and see how it goes with
yes,
everything
you can see
else.
where the pricing is. So analysts think there's virtually no return in there. That is because what they have, there's something called a price multiple. And all we do is we take the earnings per share and multiply it by the price to earnings ratio, which is just basically the price divided by earnings. And this is where the analysts think investors are going to land. It's a multiple that we often say is measures appetite to risk for investors, and analysts are saying they've only got appetite for risk for 19 times the earnings. That's what they're willing to pay. We think historically, and this is where the historic numbers come in, as an average over the last 10 years or 3 years, it's been 32%. It's currently 45%, 45 PE and 31. Over the last 5 years, it's 25. So if we just switch back, we can see that actually 18 is really, really low. It hasn't been that low on average for the last 5 years. So that's where we put our minimum. Then we put 37 and 30 to fit in with the rest of the chart here. And this is where we get the numbers from. So we think the base case, the base case is great. The bear case, there's very, very low downside on this. And then we went in a couple of weeks ago. It must have been around here. It might have been a week ago, somewhere around here, or it could have been here. Everything was double green. Everything was above the moving averages. There's no support points in sight to actually look at because there's been such a strong stock, and it's just gone up. Today it's dropped 10%, so it's down about here. Nothing to worry about from that point of view. It's a stock that, okay, it's hit the 20-day moving average, but it's got a long way to go before it hits its 50-day.
See, we come to the end of the runway here for now. We're going to do these webinars often in that sense that we will go back. We realize and we know because we all were beginners at one point. So we want to show you how the things work. And don't be afraid to ask questions in regards to what you see on screen. And also, if you are a member, then you can write us an email, or if you're in the Facebook group, pose us questions, we will answer. And there's always other members who are willing to help as well. Again, we started the show by saying 34.48%. That's the upside that we did last year on the 3-point playbook portfolio. And of course, people are thinking, but now I have to be a day trader now. I have to sit and buy and sell tons of stocks each day. That's not what we do, Liam.
No, no, we had 134 stocks. The average holding time is 60 days, something like that. So we don't chop and change too much. You might get 2, 3, 4 stocks to buy or sell in a week, in a busy week. This week's been exceptionally busy. We've sold quite a few out of our portfolio, but generally 2 to 4 stocks that you need to buy. And we're not time constrained. If you buy the next day, really doesn't make that much difference. When you've got an 80% upside or 30% upside in a stock, buying the next day can get you in at a better price sometimes.
Yeah, and that's one of the I think that the learning moments for me when I or sell. I'm almost going to say today or tomorrow. It doesn't make a big difference because you're looking at an upside that's so much higher. We're not trying to catch a fraction of a percentage extra in what we do.
Yeah, and that's the key thing. It's quite a relaxed style of trading, and it allows you to sleep well at night. That's the key thing. That's what we looked for, Hans and I, when we created this, and that's what we've effectively built.
And that is what the 3-point playbook portfolio is. That is what the tools is built around. And as said, we're going to do this again. We're going to have another webinar in English in a month's time or so. And we'll also have a Q&A webinar shortly. So in that sense, get your questions together, write us, and we'll put them in the Q&A webinar. Tomorrow, even though that it's in a different language, I just want to mention if there should be some Danes sitting out there who came in late on the show and say, I would like to see the show in Danish, you have the chance tomorrow, 7 o'clock tomorrow evening. Hans Henrik and I will be here. We'll go over some of the stocks that we had on the show today. And our guy in the studio today, in his studio in the UK, Liam, you'll get to see him again on Thursday because we have daily shows every weekday, Monday to Friday in Danish at 12 o'clock. And on Tuesdays and Thursday at 1 o'clock Central European time, Liam is there, and he is also our tech guy. Liam, while we've been talking, I can see the market has basically, it's still in red, but we are below 1% down on some of the exchanges in the US. What a day it's been so far.
Yes, it's been a bit of a roller coaster today, and the VIX is down, which shows volatility is sort of, people are coming back to normal again. So, we could see a bounce tomorrow. It might carry on for a little bit longer.
There is no doubt it is a volatile time that we're living in. As soon as there's uncertainty like a war in the Middle East, that is really something investors do not like. And that's why we are basically at the wheel all the time in regards to this. And we will send out a set emails in regards to what we do. And you'll get to see it at our webpage. Again, bring us your questions, FOMO@mystockscanner.com. They're always welcome. Liam, always a pleasure. We'll see you on Thursday on the show. For now, thank you, and thank you guys for watching tonight.
Thank you very much.
Have a great evening all.